Good morning and welcome to the Cohen Group Northwest studio. Today is Wednesday, and that means it's time for this week's market update. This week, I have a special guest virtually in the studio with me. It's Luis Gonzalez. He is a loan officer here at Caliber Home Loans. Thank you so much for joining me, Luis. I appreciate you taking the time.
Of course. Thank you for having me. I'm super excited to be on this. This is awesome.
Me too. And one of the pleasures I have as the host of the Market Update show is bringing on people who have areas of expertise and knowledge that are relevant to our housing market, but they're not the type of data that I have access to. And honestly, there's sometimes things I'm not 100% interested in myself. And so I always appreciate when my fellow nerds in the industry will join me to talk about it. And so let's dive into a very important meeting that happened last week. The Federal Reserve met and talked, and stock market had some changes and the world had some changes, and our pocketbooks have some changes, partially due to some of these decisions. So in general, what kinds of effects can we see as consumers based on the types of things that the Federal Reserve talks about and makes decisions on?
Fed's meeting, which happened early last week, was really a meeting to kind of go through where they want to see the economy as a whole move, not so much just in homes, but with the entirety of our economy and the world economy. And now that we really have the world linking up with some political tensions, it's really important that they had this meeting and set a goal for everybody else, all the consumers, us as the people, so we know sort of where we're going to go as an economy. They decided, Powell, the head chairman, decided that they're going to do 7 rate hikes this year, each one a quarter of a point. So that's going to look at 25 basis points. And they're going to do 6 more from now till the end of the year. And then they're going to have 3 more into the next year, 2023. And this is really nice to know because this is really what's going to help the financial market understand what they have to do in order to continue making the machine work and seeing how they need to adjust the money and supply of money around to us. Because over Corona, what they really tried to do, the Fed chairman Powell really stepped in as a leader and said, we need to get money out to the people so that way they're not suffering during a time where the economy it shrunk, it slowed down, everybody had to stay home and you had no choice in it. And so we needed to get paychecks out, and they luckily were able to help out a lot of the people who need it. But now it's time to take that back. And the reason for that is because inflation has been going up. Everybody's been kind of hearing inflation one way or another. Not everybody cares, but everybody cares about gas prices. And so we've been noticeably seeing that, and maybe in some of your groceries as well, inflation's been really taking a hit on those things. And so by making these rate increases slowly, what the Fed's really trying to do is say, hey, we're going to turn the economy just a little bit, and we want you guys to know that we're doing this, so that way you guys can have somewhat of a plan ahead of you, both us as consumers and financial institutions along with that.
Could it be compared to the economy is injured with coronavirus, and the Fed steps in with a pair of crutches, but now it's time for the economy to limp again, if you will, and get a little bit stronger?
Yeah, that's a great way of putting it. One really amazing way I've heard of it, this is not from me myself, but the Fed basically pushed the pedal down all the way as if they're driving a car, and they hit it to full throttle. Everything that they have as mechanisms in order to keep the economy moving forward and faster, they've pressed down hard. They decreased interest rates almost to zero again, which the last time they've done that was back during the last recession. And there's a few other things that we could get into, but they start to get very technical. The main point being that they've exhausted all of their elements, and that's great during times of need. But once, what we're seeing as the repercussions of it that they didn't anticipate was inflation that's not transitory. Transitory means that it came and it's likely going to go away in a very quick response. We had supply chain shortages across the world. And so because of that, prices like lumber jumped up extremely high. And they thought once the supply chain gets figured out and people start doing business again, it'll shrink down. We're starting to see that's not happening. And so they're really stepping in and they're saying, okay, we need to pull off these levers, because if we don't, inflation's going to keep rising because we have so much money out in the market, free money basically. I mean, 3% interest rates, you'd be crazy not to take advantage if you know how to do it properly. And so they're going to take that off, and they want to save those for rainy days again. So now that the economy is back up and running, they need to let off some of these levers so that way they have the opportunity to use these again, slowly get rid of inflation how they see possible. And if they need to make adjustments, that was one of the very big things that Powell was saying, was the 7 rate hikes for this year and the 3 for next year are their estimations for what they're going to be doing. And if they decide to, based off of the political environment right now, or since we are a global economy, if any of the other economies start to see setbacks, we have to adjust with them. These things are very fluid. They could go either slower, meaning they will do less rate hikes, or they could go faster. Faster meaning they want to decrease inflation and they think that the economy is able to withstand some of that pressure without making us go into a recession.
And it looked like of the 9 members of the Federal Reserve, 8 voted in favor of this 25 basis point rate, and the only one who disagreed actually thought it wasn't enough and wanted to do a half percentage point or 50 basis points. So it seems that as a whole, the Federal Reserve is saying this is absolutely the direction we have to go. It's just a matter of how quickly.
It was funny because I watched the entire Fed meeting, and it really was a consensus between everybody. They want us to slow down this economy because inflation is almost on like an exponential increase. And if we do not stop it now, we're going to fall back into the times of like the 80s where we had 18% inflation, excuse me. And when you get that high, obviously everything's expensive, but you need to take very drastic measures to decrease it. That would be like putting all of these rate hikes in at one time, and maybe even more, and completely slowing down the economy, basically telling everybody we're going to be going into a recession. We have to, because we need to get this inflation down.
Now, some of the terms that at least I've heard floating around over the last couple of years are quantitative easing, and then more recently quantitative tightening. Is that what this is what this is referring to then? Is over the last couple of years, the Fed has allowed more and more liquidity into our financial market just as a whole, and then now it's time to kind of pull back some of that? Or is this a different topic?
Quantitative easing has a lot of different ways. This is basically all the ways the Fed can boost up the economy.
Gotcha.
And this is one specific way, is the Fed's fund rate. And so by increasing it, they're able to slow down the amount of money that's being distributed into the economy. So basically they have their interest rate by which the financial institutions are able to borrow from them. And in order to make their profits as institutions, they need to raise their rates as well, which then goes on to the consumers, whether that's a consumer like you and me, or if that's a consumer like a business who's trying to do startups. So over maybe not Corona, but other times where we had heavy quantitative easing, we have a lot of money in the market, cheaper money basically, where startups are willing and able to take on some of these funds and liabilities in order to hopefully produce economic growth towards the future. And once you start doing restrictions and you slow that down, then you're going to see a lot less startups. You're going to see a lot less people taking out loans for cars and all of those good things.
And so then thinking about the typical home purchaser, now when the federal funds rate, say, goes up by 1% over the course of, 4 rate hikes, does that mean then that there's an exact corollary that a homeowner's interest rate goes up by that same amount?
No, actually, which is funny, because the general media will make it kind of seem like that by, interest rates are going up with the Fed, which means your interest rates are going up. really what's happening in this market specifically, which is very fascinating, but takes multifacets. And honestly, we haven't been through something like this
Mm.
uh, in really any other era, because there's just so many different parts coming out of a deep recession, but a very quick one with a ton of Fed involvement. And then the Fed saying, oh, we need to get out of this as quick as possible. And so what we're seeing with home prices and just the general interest rates on home loans is that we're seeing institutional investors and investors starting to pull out of the stock market because there's a lot of insecurity in the economy, as the US economy, and also as the world economy, again, with political issues, just with coming out of Corona and having to stop inflation. And so those investors are going to start moving their money into two other categories, which are mortgage-backed securities, which do involve us, and then treasuries. And it kind of goes in a matter of like which is safest to store your money into. A lot of people are skipping the mortgage-backed securities, people and
Mm.
institutions, and going straight into treasuries, which are considered a bit safer. And so that's why the Fed actually decided over Corona that they were going to start purchasing mortgage-backed securities, which is why we saw that huge decrease down to 2.7,
Mhm.
low threes for interest rates. And they're still doing some purchasing, but it's very minor now. And they're really trying to get it to where institutional investors, other governments, they tend to buy mortgage-backed securities. So you'll see like China and other places also buying these mortgage-backed securities, but they need a return on that
Mm.
that can compete with inflation. And so when you have 7, 8% inflation, in order to go into a safe market where they want to get some return, not enough to beat inflation, but enough to say, hey, at least this is a hedge against holding cash. And the stock market, I don't really trust right now because there's too many things moving in the world economy that I don't feel secure about. I will go into mortgage backed securities as long as I can get a decent enough rate for me to feel like I'm getting a good investment on something that's safe. In order to do that, the Fed has to move out of that market, and they're doing that slowly. They've been doing that very slowly earlier than these interest rate hikes. And by doing that, that's why we saw somewhat of an increase over time over this year and maybe a little bit early or late last year. And they're really trying to start to get, okay, can these other governments or these other institutional investors, whether it be companies, can you guys start moving into this market? But you're going to start moving into this market once those interest rates rise. And that's going to
Gotcha.
directly come down to you as the consumer, as what your interest rate is going to be over the next year or two.
It's like just it's following the money, but it's also following the bets about what's going to happen to it.
Yeah, the bets is the interesting part because people are making bets on what they think the economy is going to do, but
Mhm.
it's such an insecure time. This is something that in recent the Fed's actually been doing, where they used to hide in secret and then they would throw out what they're going to do,
Mhm.
and then the market has to react. So you'll see huge dips or huge rises in the stock market. You'll see these other things, mortgage-backed securities and treasuries, go up and down, and that gives a real big shock to the
Mm.
economy. When you have that big of a shock, the people as well, us, also go into shock. We see that huge drop, but we don't understand what's happening. So then
Mm.
we start doing sell offs and it becomes this big spiral. Well, what the Fed's decided to do is just what they've been doing now. They're giving us that heads up. Hey, this is what we're going to likely be doing. Don't take our word, but we're going to give you as much as possible right now
Mm.
before we make the actual move. And so that way institutions can start to, they have a time lapse where they're able to use their analytics and their data in order to understand, okay, how is this going to affect the economy
Mhm.
over the short term and long term. And so by the time the Fed just made their first rate hike, we've already had a lot of that priced in.
Mm.
So that's why we've been seeing over the past month or two an increase from the 3% range up into the 4% range when it comes to home loan interest rates.
And I think too, it's important for all of us who are in the home buying market or considering the home buying market to recognize some of the longer history of home interest rates. We've heard about, threes has sort of, at least in my limited experience in the last 4 years, has sort of been the golden number, is somewhere in the threes. And then last summer I was like, oh my goodness, 2.8, 2.9, what an incredible rate. And then as soon as things start upticking towards 4, people freak out.
Yes.
Versus what were rates 10 years ago, 15 years ago, and especially 30 or 40 years ago.
In the last 10 years, we were really between like 6, it got down to 6s and people started celebrating. And then it gets somewhere into the 4s. And then we have Corona, and then it drops down. And now it's coming back to actually where is really the median that we've seen for the past 10 years. But as consumers, we tend to forget the history of all these things, or we just weren't a part of buying a home back then.
Right.
And so you have a lot of first-time home buyers coming into the market, and this is the only market they know. And that's going to really lead into why you need to set yourself up prior to going out and trying to get a home. You really want to give yourself some time to speak to somebody like me or other people, other lenders that can help educate you on the process. So that way, by the time you're ready, you're comfortable, but also set some expectations for what they see the market doing for the next few months, because you want to be able to come in with a plan of how quickly do I need to get this done if I want to qualify for this much, or what can I expect if I do wait a year out from now, or even 6 months from now. We can't give you the exact answer on what to do.
Dang it.
Because I know.
Imagine what your fee-based consulting services could be.
But we do want to help you understand, okay, when we look at like home appreciation, we were just talking about, and it's been a big topic in the news of why homes are appreciating, and we thought that it was going to slow down this year, and now it's looking like it's not, given that new construction is still slow, though there is some sentiment that it might be increasing. We've been saying that for the past 2 years.
And to build a home, you need lumber, and to build a home, you need garage doors to come in less than 6 weeks.
And then inflation on top of that. And so all these are actively come together. For somebody like myself, when I speak to a client, really what I'm trying to do is set expectations that help them ease the nerves, because buying a home is going to be one of the most stressful things for you, yourself, your partner, your family, whoever it may be, in your entire life, at least the first time around. To have that extra time to really understand, okay, am I interested in buying a home? If you are, by even the slightest, talk to a lender, because you want to get the gist of what the market's doing, also how you can compete in this market and not feel discouraged, because almost always we get a client and we have 1 or 2 things that we ask. If you have 3 months, we'd like to see you improve these 2 areas, which can greatly improve your competitive value when it comes to going out with your realtor and making offers. And when you can make a solid offer the first time, you're going to feel a lot more comfortable with the process than bringing it all in at once.
I agree with all of that. Everybody needs to talk with their lender before even calling my team, which pains me to say, but it's absolutely true that even if you call my team first, we will nearly instantly, we'll say hello first, but then we will instantly refer you to one of our trusted loan officers because of exactly that. When things are changing so much, you have to have a professional who knows your finances, knows your situation, and can offer things like credit repair or advice on, if you do this, and this over the course of a couple of months, your credit could change significantly. Any other number of things or questions that you might have around gift funds or co-signing with another person who has more significant assets to lend off of. All of those are questions that should be answered very early in the process. And none of those are things that your realtor can help you with, unfortunately.
This is actually leads into kind of where the lending institutions are trying to combat sort of the scenarios we're seeing in the market, you're going to see over the next few years a lot of new programs coming out that are trying to find those niches where, say, conventional or FHA clients who are no longer qualifying for exactly what they qualified 6 months, 3 months ago, even, we're actively working, and other companies are actively working on trying to find more niche products that can help bank statement reports rather than a 2-year history of your 1099s and other tax forms. That way we can quickly get people like you into a home before those houses go off the market or before the appreciation pulls you out of the market. So over the next year or two, you're really going to see a lot of programs coming out. And so that's another reason why you want to actively be talking to your lender, and they'll be actively talking to you as well, because if they find that there's a new product that can support your needs now, they will show it to you. Absolutely.
And that's so good to hear, especially with, at least anecdotally, the rise of the gig economy, the rise of the freelancer economy, a lot of small home businesses that you're not 100% sure what they qualify as or don't qualify as, but the more niche products that can become available, the more people don't have to fit into a very conventional, to use for lack of a better word, but conventional product.
Exactly. And these products will definitely, they're not the Goldilocks products. It's not a get a contract going and then in 30 days is the only amount of time you work with your lender to get them all the things you need. It's going to take a lot more work on some of these new niche products because they don't go to Fannie and Freddie, the big government-backed agencies that support the housing market. These are private loans that are being made. So you're going to need a lot more time with your lender. I would say even like 3 months minimum with some of these loans in order to get all the right documents set up, work with the lender's underwriting team and everybody attached to it. It's going to take a little bit more time. So if you are in any of these categories where you might be self-employed, any tricky financing, whether it comes to you just inherited a lot of money, you want to come in early, especially in this market, to figure out exactly how you can go in and then win the home you love.
And I think that leads into two plugs that I want to make about lenders and lenders in our community is looking at more portfolio or unique loan type products, working with your lender for a longer amount of time. I think that it reinforces the importance of working with a local loan officer where you, and Luis did not pay me to say this at all, but where you can pick up the phone or you can text your loan officer and you will reach the same person. It's not a 1-800 number. It's not a 1-888 number. It's not a 9 to 5 schedule. It's someone that you can talk to on a Friday afternoon or on a Saturday morning or on a Monday afternoon, and they're going to get back to you. And then the second element to that is if you're working with someone so closely for so long to find a fit for your loan product, there's something to be said about working with people you like, someone that you enjoy having a conversation with, that you enjoy nerding about these types of things with, someone that you feel like you can trust throughout the process, and they're going to not only be competent, but they're not going to make it harder than it has to be. And you'll enjoy picking up the phone when they call. So a huge shout out to local loan officers in our community, one of them on this call, of course, for all that you do to connect with your clients and your colleagues in the industry personally, and just be that amazing resource to all of us.
Thank you. Yeah, it's really shown actually in this past market how important it is to have a local lender, because the people that are able to reach out to you by text, by phone, email, outside of general working hours are the ones you're really going to build that relationship with and understand the most. We really grab and hold on to our clients in the sense that we care about you, and we sometimes even personally meet you and get to know your personalities and what you're looking for, so that way we can best help you. Versus when you go to, I'm not going to name drop any online, lenders, because they have their purposes, they do. But when it's such a tight market where real estate agents work best with a local lender and they know how each other communicate. And then that moves on to others like insurance agents. When
Mhm.
all these people are cohesive and combined, that's where you as the client are going to have the least amount of stress,
Mhm.
because you know all of these people are on your side and they're doing the work.
Yep. And
Where
we're all
once you
talking to each other.
Exactly, exactly. And once you start moving outside of that realm, there's always caveats to why you're paying the cheapest rate. When we have 30-day windows to do closings in this market, good luck with some of those caveats. They may end up hurting you more than you wish they did. And so it's such an important time, not just for lenders, but everybody who's involved. You want them to be as close to your market specifically and as close to a personal relationship as you can. Really stay active with people you trust when it comes to this type of information,
Mhm.
whether it's lenders or other people you know who love economics, because things are moving so rapidly and changing so
Mhm.
rapidly. Again, I mean, I don't try to go back to this too much, but the political tensions are
Mhm.
really throwing a wrench in this whole situation where
Yep.
when we have these types of political tensions, that's inflationary on its own. And
Mhm.
so the Fed and everybody institutions are actively changing day by day. I would say to real estate agents and other people that are attached to the real estate industry to one, really focus on what you can control,
Mhm.
because you can't control the Fed. But at least we have a Fed that's really actively trying to not only combat some of the things we need to combat, like inflation. It's absolutely imperative because it's no point in trying to buy a home when you can't afford your gas and groceries by the end of the month.
Mhm.
But on the other side, they're really trying to keep us from going into any sort of deep recession. Likely, the things that we're seeing are going to bring us closer to recession tendencies in the economy. But that's not a bad thing. Recession gets a bad rap, but if it's manageable, you
Mhm.
want that because you want prices to stabilize. You want home prices to stabilize, which we're not seeing. So that's one key aspect to the Fed and the housing market, is that though this is a long-term strategy that we'll see play out over the next few months, right now when it comes to homes, prices are still going up. Zillow just came out with an estimate of 22% nationwide. Last time before that, we saw lower end estimations. And so a lot of that's coming from supply chain shortages when
Mhm.
it comes to new home constructions. When we have rising interest rates, you tend to see less construction being built towards homes anyways. And so we're going to see that supply chain kind of be, or supply limit us a little bit and see those prices go up. Demand is going to be falling down somewhat as certain people do get priced out of the market.
Mhm.
Unfortunately, it's one of the things that does happen when these type of Fed meetings and restrictions apply to the economy. But that's not all doom and gloom, because it's going to help tamper down some of these rising increases in home appreciation and allow some of those mid-range buyers to actually be able to compete, not have to put in 20 offers against 20 people each time.
Right.
So you'll see a little bit of a rebalancing. It's not going to come back to where we were prior to 2019, but we're going to see somewhat of a slowing down, hopefully, as these interest rates go each each time they decide that they're going to be increasing the Fed's fund rate.
Thank you so much, Luis. This was such an informative
Of course.
conversation. I know that I learned a lot, and I know that everybody who is watching this is learning a lot from you today as well. So thank you so much for sharing your time and expertise today.
This was such a joy.